So let's try and get back. Now, what I think I would do is, so some of you were asking me just now about the early exercise questions. I think they are the hardest part of the course, and what I'm going to do is I'm going to answer the questions that have been sent to me, and then I'm going to go to question set 3 and explain that in detail. And after that, I will give you a briefing or a summary of the key concepts of this course. After that, I don't know if we still have time or mental energy, honestly, to go further and discuss early exercise. But we still have a bit of time. So I'm likely to try to respond and help you on the early exercise, maybe via audio visual, video format later on. But don't worry about that for now, okay? In the next 5 days, and deliberately I wanted to make sure that there is some gap between the last tutorial and your final. So if you have some more questions, you are more than welcome to write to me, and I will respond to you, okay? Okay, so let's have a look at this one. This is now from somebody else. I have a question. In lecture 8, page 33, it is said that we will only lose money if stocks move correlated and co-integrated. All instruments up and down the same percentage. What is the respective meaning of correlated and co-integrated? Correlation just means two things are moving in the same direction. So if one thing goes up, the other thing goes up. If one thing goes down, the other goes down. That's correlation. Now, co-integration is actually a stronger version of correlation. Co-integration means if one thing goes up by 1%, the other also goes up. Not only it goes up by 1% as well. Okay, so it's actually it's a stronger requirement. Now, with these dispersion trading, there are two key points. Key point number one is that when you have a basket, you got stock 1, 2, 3, and 4. And if you are lucky and 2 of them go up, 2 of them go down, so end up the index, this is the index. Index doesn't do anything, okay? And you sold, so you are long options on the stocks, calls and puts, and you are short calls and puts on the index. So on your shorts, you don't lose any money, but on your longs, wow, you're gonna really clean up, okay? So that's dispersion trading, but of course that's a privilege, and you have to pay for it. And if this doesn't happen, well, then you lose money, okay? But if it does happen, then you really can, it can be very profitable for you. Now, the two further points to make are that even if the stocks are correlated with each other, so they all move this way, so that means your index will be doing that, okay? Even if that happens, as long as they move by different amounts, X%, Y%, Z%, or A%. So now they are correlated, but they are not co-integrated, okay? You will still make money. So the worst thing is when they are, which will be very unlikely, okay? When they all move down by the same amount, then you are not going to make money from this dispersion, but you will lose money because you pay for it, and you haven't got any profit to show for. Okay, so that's the point. Now in lecture 8, page 40, a bit too small for you. How to understand the skewness impact downside dispersion. And the resultant trading opportunities. Now let's go to lecture 8, page 40. So lecture 8. Oh, it's almost the last page. It's the second last page. What does this sentence mean? It's a little bit vague, I suppose. When in indices the downside skew exceeds that of the single stock, this drives a skewness in the correlation number itself. Now, I don't blame you for wondering what the heck is that. The thing is, you got to understand a little bit about how markets work typically, which is if this is time and this is price of a stock or an index, okay? So normally they would do this when they're going up, they go up little by little. But when they go down, boy, they just do this. And it's been like that for the last 200 years, okay? And it will continue to be like that. I think human psychology has something to do with it. When we get on a train, when we take money out from our wallet and buy something, a stock, or make an investment, we're very careful. We think and think, we think this, we think that, and then we see, oh, all the other people are doing, so I should join. That is why when it goes up, it's slowly, little by little, one by one, you get on a train. But when things start to go wrong, everyone wants to get off. Right? I think that's the psychological insight behind why markets are like this. You know what I'm saying? Yeah. They really are. Look at the S&P. Don't take my word for it. Look what happened there. Okay, this was just 2 weeks ago. Goes up little by little. It will happen again. Okay, and what this sentence is trying to say is that if you do the dispersion trading, so you buy the calls and you buy the puts of these stocks. So you are long vol here. So here you are long sigma, and then you are going to sell the calls, you're going to sell the puts. So you are short vol of just the big index. So that's what you're doing. Now, what do you want to happen? What you want to happen, number one, okay, is that these go all over the place, up and down, and hopefully the index doesn't do much. That's what you want, number one. And number two, even if that was not the case, and especially when markets are going down and correlation starts to increase, what you want is for these stocks to move down far more than the index. Okay, now here's the problem. As I'm sure you must have realized doing your assignment number 2. So you got like 30 different stocks, and not all of them have call and put options. So normally it's only the bigger companies, right? So bigger companies, but your index on the other side, your index represents everything. So here's a problem. So you are able to buy calls and puts of some of them, calls and puts. but not all of them. And normally, when you are able to buy, so these will be bigger companies, and their stock prices may well be more stable than the smaller ones where options do not exist. Okay. However, on your liability side, and I think it is correct to call it that, okay, you are talking about the whole index. So what if when markets go down, this goes down a lot, but the stocks that you are long puts, they go down just a little bit because you had to reweight them, then you could end up losing money. That's what that is trying to tell you. Okay, so when there are downside skews of the index is higher than, I think this doesn't happen very often, but it is possible. Okay, this also explains. I don't like to sit down all the time. It records better when I'm sitting down here. This also explains why, when you look at the volatility of, let's say, a put option. So if the stock price is here right now, and this is the implied volatility. So this is at the money vol. Now Black shows, if you believe in their formulation, the wall should be flat everywhere, regardless of what strike you have. Okay, so these are strikes. Sorry, strikes, and this one happens to be the stock price now. But we know that in the real market, it's nowhere near, and the volatilities are kind of like this. It's high. It's, first of all, it is skewed. It's not constant, and it's higher on the downside. And this is exactly capturing the empirical observation that markets are doing this. So this is another way of saying, well, I think, there is a bigger chance of a market downturn than what the normal distribution would suggest. So therefore, I want to have extra compensation of very, very extreme moves. Okay, that's, if you understand what I said just now, you really understand what skews are. Okay. Yeah, so I think I've answered that. Now you might wonder, well, under what circumstance can you have a very substantial market crash and some stocks do not drop as much, or maybe they even go the other way? Okay, does that really happen? You know what I'm saying? That's what we worry about. Now, I find one very interesting example, and this is a regression of market returns on the x-axis, and this stock's performance on the y-axis. So typically, you would expect it to go the other way. If CAPM is correct and your beta is positive. Now, this stock actually has a slightly negative beta. Can you see on the right-hand side? Minus 0.043. It's quite hard to find something like that. I managed to find one. This is a Korean company called CJ Entertainment. I have told some of you this before. Now, you know this band? 少女. Huh? They're not so 少女 anymore. But this company is an entertainment company for acts like this one and some movies and some other K-pop bands. And this isn't over just, a couple of months. This seems to have persisted quite long. You can see there are a fair number of observations. And when you do a regression, at least it definitely goes the other way. So it's very, very, very strange. And I talked to some of my Korean friends. I said, why do you think this happens? And they said, well, when the economy is bad, first of all, people just stay home. They don't go out. They don't have any money, okay? And they need something to cheer them up. So they just go home and they just watch 少女时代, okay? So I said, okay, I'll accept that. Okay? These stocks are interesting. Okay? All right, now here's another one. Dear Sam, I'm confused why the absolute value of in the money and out of the money OTM delta both raise when volatility raises. He's talking about here. Now, I have to apologize because I think I made a mistake in my notes. And this, I think, was the last, maybe the last question in set number 2. So I will go right there. I think it is this one. So this is our question set 2. Okay, here we are. So question set 2, question number 9. And you have option pricer showing you the following. So the share price right now is 65. Delta is 40, but notice there's a minus sign in front of it. Okay. Gamma 2.5, Vega 0.18. And I now raise my implied volatility and recalculate. And I get the following values. Now, what this is saying is well, let me try and make it simple. If you, I need to open a new. So underlying is 65. Let's just say the exercise price was 60. Well, some of these parameters I have to just make them up. Doesn't matter. Okay, so you're pricing an option where the underlying, I'm looking at the puts, okay, put option, maybe 62. $64. All right, that's more like it. Okay, now I'm looking at pricing a simple option like this, where the price of the stock right now might be around 65, and I'm looking at a put option where the exercise price is 64. Don't worry about the other parameters. The question is, what happens to all those Greeks for the put on the right-hand side if I change my volatility from 25 to, let's say, 30? What happens to my Greeks when I recalculate? Now, it's okay, it's easy if you have a machine in front of you, but if you don't, I think we went through that last time, and the logical steps, I'm happy to go through this again. Okay? The logical steps for me, step 1, I just take a look at this and I know that I am long options. First, I'm long options. I don't even care calls or puts because I have positive gamma, positive vega, I must be long options, okay? And number two, I'm long a put, and I can see that because the delta is negative. A call delta is positive. So if the delta is negative, I must be long a put. And number three, it's out of the money. Now, how do I know that? Because the delta is less than 50, or at least the absolute value. You should know by now, if you talk about a call, so your delta here would be approximately 50. So over here it would be, 60 or 70. Here it will be 40 and 30. If you have a put, so here it's still 50, but now it's minus 50. So here might be minus 30, minus 20, okay? Now the sign is something you worry about as a second step. But I always worry about the number first, and then I worry about the sign. So the question really is, you raise your volatility. So now what have you done? So you, like Sherlock Holmes, you have figured out you are long option, you are long a put, and the put right now is out of the money. So if you were to use this as a map, you are actually somewhere around here. All right. So my question to you is, what if you raise volatility? Well, you raise volatility. So first of all, your payoff would look like that. And what you need to do is to ask yourself, well, in that case, what values did we have? If this was minus 40, then, boy, these are hard to draw. And my chair is sinking. Then what would happen? Whoops. Then what would happen? That's not very good. To the delta of this line here. Okay, now you have to kind of imagine that as this line sinks, your delta will gradually do this. But when you go the other way, it's going to get steeper. Okay. And another way to try and visualize that is, and I think I have done this with you before, by calling up those interactive Greeks and looking at it and playing around with those payoff curves when you are changing one of the parameters. So here I want to look at a put, and what I'm saying is, now this is exactly it. Okay, so your strike price is 100, and so let's say your spot price is around 110. So you are roughly here. So your delta now look like this. So what happens when I change the vol? Well, it's going to do this, right? It's not moving a lot. Okay, but you can see that your delta goes from being flat to higher as you are raising that curve. Okay? Is everyone okay with that? Actually, we already covered this, but I just go back to it. Now, so when you are long put, when volatility goes up, then your delta goes up. Now, here's the part I want to apologize. This one should be the other way, okay? So you spotted it correctly. I am sorry. I was just too fast. Okay. Now this is correct. And so you know that C and D cannot be the right answer because the absolute value of delta has to be higher because the line is now getting steeper. Okay, so it has to be A and B. And I think we figured out that Vega would go up and gamma would go down, and that has to do with the convexity of the curve as you are pulling it up and down. Okay, so I don't want to waste your time talking too much about that because we discussed that last time. But it's all to do with the curvature of this line and how the slope is changing and the curvature is changing. Okay. All right, now I want to get on with the sample questions, and I'm going to start with number 1 in set 3. So you might want to just turn to that. Let me just space it out a bit. Now, in this question, there are 2 options. The first one actually is a shorter time frame, it's 1 month. The second one is a longer one. And what you can see, first of all, is that the first one has a much higher gamma and a much higher theta. Of course, that is to be expected. So shorter term options have higher theta and higher gamma, but we can actually dig deeper. And what you can do is you look at option A and you say that, okay, theta is equal to a half times gamma times sigma s all squared. So for option A, that means 3.5 is equal to a half times 20 times well, it doesn't tell you what S is, but it doesn't matter. So we just leave, because it doesn't tell you what S is, we can just leave that for a moment. In fact, you can even use 1. Just imagine the price was the stock price is now $1, okay? So you have this one. So this is a 30-day vol. So sigma sigma s all square is equal to 0. Okay. Whereas for option B, you've got 1.5 is equal to a half times gamma times the 60-day volatility. And if you were to solve for the 30-day, you'd find that this is what you get. I'm just moving everything to the other side. Okay. Now the S here doesn't really matter terribly. So I'm just going to strike that up because they appear in both equations. But the point here being that the short-term vol is higher than the long-term vol. So you have a situation. Now this is again, you look at something like this and it's likely to be a question about forward volatility. Okay. So here is the 0 to 30 and here's the 0 to 60. Now a possible explanation for this structure, why is it that the shorter term volatility is higher, is that there is one day in the first period where there is possibly an earnings announcement. So the correct answer actually is B. Okay, now it is a possible, so you just, if you had to pick the best answer from here, B can actually explain. I mean, you can say D, but you know, the thing about the art of multiple choice is that you always try to pick the best answer. And the best answer for me is B is capable of explaining this. Okay, whereas A is wrong. And C, well, we don't know because we don't know anything 60 days afterwards, beyond 60 days. Okay, so the correct answer is B. Now, the next one. Now, this is actually just bookwork, and there is a formula in your notes, and also I gave you a spreadsheet which I uploaded. You can figure out how to do this bootstrapping, but the correct answer actually is the third one, C. Okay. Make sure when you go home that you are able to perform this simple calculation. There is a good chance that it might come up in the exam. Okay. Now question 3. When the share price is 100, I have the following. So I'm long call at 95. I'm short put at 105. Now before I even go further, I know that my call is in the money and my put is also in the money. Long call at 95. Short put at 105. Okay, let me copy this page because I want to have more space. Okay, so I'm going to tackle this question 3. Now I have more space. So the share price is 100, and I'm long call at 95. I do know the answer, but I'm trying to think of a good way to explain this to you. All right, so you're long a call 95, which is in the money, and you are short a put 95, which is also in the money. Now, actually, your payoff looks like this. So here's 95, here's 105, now if you're long a call and you are short a put, you don't really have a position. And right now the price is 100. Okay. Now let's try and put some numbers. This is how I would do it. Okay, so let's take it, and I recommend this would surely work in the, if you are methodical about it. Now I'm going to do it before and after. So you have a 95 call, which is in the money. So there will be a delta for that. Let's just say it's because it's in the money, it has to be around, it will be bigger than 50. So let's say 52. Okay. And there is a put. So you're long a call and you are short a put. Now the put delta would be somewhere around 52 as well, because it's $5 either side. But because you are short the put, you are also long delta here. So what happens now? You want to hedge this. In order to hedge this, in your hedge, you need to sell stocks, and you're going to sell around 104. So your total will be 0. Now that's before. What happens after? Well, you have to ask yourself, I now lower my volatility. So this is the opposite of what happened last time. Okay, it is basically the question is asking, what happens to the delta when I'm shifting this up and down? That's what the question is asking you. Okay, and I was here. The way you would tackle that is, for the call, the delta would actually increase, and for the put, the delta would increase as well. Now maybe you're wondering, yeah, why is that? Well, you have an in the money call. Actually, the best way is to let's look at a call option. Okay. So you're in the money, although this one doesn't really show very well. So I probably need to draw it. We have discussed this before. So I'm kind of repeating myself. So let's say this was before, and it's a bit exaggerated the way I'm drawing it. This is before. Now I give you the after picture. Now I just said I lower my volatility, so your payoff would look like this. So now you are like this. So you can see that there's a steepening, which means that delta must go up. Okay, we have discussed this many times before. Okay? And the logic for the put actually is somewhat similar. So they both go up. Now what? So your hedge has not changed, but guess what? You are now long delta. So the correct answer is B. Okay? Is everyone okay with that? I love these questions. I really do. Because they, for two reasons. One, I don't need to remember anything. And for me to figure it out from first principle, I find that, it's a lot of fun. Okay, let's get on to question 4. Now, I hope to be able to let you go by about noon time, because we did say it's from 9 to 12. Anything that is unfinished, I will make sure I cover it and provide it to you. Okay. Question 4. With the share price of 100, I have the following. So I'm long 2 puts out of the money. I am short 1 put, which is in the money. Now, you have to try to remember there is a certain graph. And here I give you another tip for your exam. Not tip, but a piece of advice. Okay? Remember these graphs, which are very handy. And especially the one in the middle. Okay, now what graph is that? This is the graph of what happens to your gamma. Let's say you have an option 50 strike. What happens to the gamma when it's at the money, when it's slightly out of the money, and when it's far out of the money, or far in the money? Okay, so there is some approximate symmetry to it. The point being, when you have an option and so here you are in the money, or you are near the money if you like. Sometimes I say that. Near the money means either you are here or you are here. Okay. So you are here, you're out of the money. There is an approximate symmetry. The gammas are approximately the same, which is another way of saying the curvature here and here are similar. Okay, now that being the case, go back to this question. Oh, what I said to you, I have a piece of advice for you for your exam. What's that? My piece of advice is this. Okay, You don't have to listen, okay? But that's what I would do if I was a student, okay? When you take your exam and when you sit down, the first thing you do is write down your name. But the second thing I would do, I'm going to draw these three diagrams somewhere on the question paper, because I know I would be referring to them at some point. I can guarantee you that. Okay? So in order not to have to fumble and say, oh shit, what's going on? I'm just going to draw them first and get them out of the way. Okay? Now, the question, what question was it? This one. Requires you to apply the understanding. So I'm going to reproduce that gamma diagram. So this is at the money. This is slightly in the money. So this is, let's say, 100. This will be 105. Sorry, it's not really drawn to scale, I know. Okay. The y-axis is the gamma. The x-axis is just the spot price. So this is 95. So immediately I know I have to be gamma long. So forget about C and D. Okay. The question is, am I Vega long or am I Vega short? Now, the way you measure Vega, as I have said to you, is the sensitivity of your option price to the change involved, which is related to the shaded area and how thick this part is. Okay, so when you are here and the distance is maximum, that is when Vega would be biggest. And you can easily verify that by looking at the Vega parameter. Let's reset everything to 100. 100. Okay. Now Vega here is 0.114. It will be higher than anywhere else you care to look at. So let's say 105. So now, okay, it's 0.114. It's about to change. So Vega is lower. Okay. And on the other side, it also works. Vega would be, it would not be exact, but it's very close, okay? So I know that since I am long two options and I'm short one, and they are approximately symmetrically near the money, I have to be long Vega. Okay, so A is the correct answer. Okay. I'm sorry to download so much material to you guys in one go, but just doing my best to help you. Since everything is recorded, if something doesn't hit you right now, just go home and have a look at it. Okay. Now, question 5. Are we on question 5 now? Yeah, question 5. Let me just space it out a little bit. With the share price at 100, I have the following. So I have long one call at 95, long one put. So now I don't have that double option thing from the last question. At the moment, my Greeks look like this. So delta neutral, long gamma, long Vega. The share price drops $2.50. Volatility rises 2 points. Ignore the time decay for now. So this is calculating same day profit. We do not keep gamma Vega constant. I earn less than 25 or between 25 and 26 and a quarter. I earn 26.25 or I earn more than 26.25. This is a brilliant question. Now, and this question also, I think it provides some insight into the limitation of Greeks and how traders can screw up. Well, not screw up, it's not really their fault, but traders need to be careful when just looking at the Greeks. And I'll show you why, okay? Now, step by step. So you're delta neutral, or you delta hedge, okay? So you're long to gamma. So what is your gamma revenue? It's going to be a half times 2, that's the gamma, times the square of 2.5, and that is actually $6.25. Now you get to keep that, okay? And you are long options, so you want volatility to rise, and it did. It rose by 2 points, and you are long 10 Vega. So these are, like I said, they are dollar Greeks. So you earn another 20 bucks. So you're happy there as well. So it looks like C should be the right answer. Is it? No? Why not? Because the gamma change, and you actually make more money. Now, that is one way to think of it. Another way to think of this is, let's say, okay, let's look at this. Now, hold on. Now I have, okay, have a look at this screen on top. Okay, now I have an option where the exercise price is 100, and the underlying right now is around 99.5. Now just imagine for a moment, you are long the call and you are long the put. So you're long everywhere. Okay, wonderful. So you're long gamma, you're long Vega, you earn gamma revenue, fantastic position to be in, except you pay money for it. You're going to be paying close to $6.80, $7. Okay, now the thing is, you ask yourself, okay, what is my delta position here? Your delta position will actually be quite close to 0. That is because you happen to be a big spender and you are long a call and you are long a put. So this one is approximately 50. This one is approximately minus 50. So it looks like you are delta neutral, but actually you are not. Well, you are, but you are only at that point, okay? The moment things start to move around, you're going to make money from delta, from either your call or from your put, okay? That to me is a better or equally valid explanation as to why why you make more than 26.25, because this so-called delta hedge does not tell the full picture of what is going on when you are long a call and you are long a put, and the call delta and the put delta are hedging each other. And that goes back to my statement earlier. If you are a trader, you have a book, you have a portfolio of options, you have thousands of options, and quite often they go in the opposite direction. You think, oh, I'm pretty flat on delta. Well, you could well be wrong. Okay, so this is a simple example of that. Okay, so that the correct answer is D. Okay. These questions actually were constructed by Govert and his team, so maybe they discovered from experience that, you know, you can earn a lot of money or lose a lot of money from delta, even though it looks like your portfolio is delta neutral.
Your stock price for say here, say it drops and it's closer to the stock price, and isn't it that your gamma get higher and your gamma revenue got higher?
Yes, yes, that is true. Yeah, well done. Well, actually, the reason I took a little while answering is I was thinking of the gamma for both options. In fact, they are both increasing, both of them. Okay? So what you said is correct. It's closer to being at the money.
But the volatility is rises, so the gamma it should be dropping according to the volatility drop. So we cannot judge whether the gamma will rise or drop.
No, I think you can make the assumption that, or at least for the purpose of this question, when you get closer to the money, gamma is going up.
But the volatility rise.
Yeah.
Volatility rise and the gamma drop.
Volatility rises, gamma can drop. Okay, why do you say the volatility rise, gamma will drop?
The volatility rise and your curve is non-equilibrium. According to the convexity and gamma.
Ah, okay, I get you. Well, you basically have two things in opposite directions. It is true. Whatever is the struggle between gamma and vega, what I said to you just now regarding the delta, that remains valid. Okay. Because you are long a call and you're long a put, you thought you had no delta, but actually you have a lot of delta either way. So you will make extra money from that. Okay. So I stand by the point that I made earlier. As for gamma, yeah, so when you get closer to the money, gamma increases, but when you raise volatility, gamma will go down. But this question is kind of unclear on how they are supposed to offset each other. But you understand my point about the delta, okay? No. You cannot. Okay, good. All right. If you don't understand, say so. Now, you understand what I'm saying here. Imagine, look at this, and imagine you are long the call and you are long the put. You are long both. All right. And what would be your delta of a portfolio like that? your delta would be close to, let's just say zero. Let's just say zero, okay? The call delta is around a half and the put delta is minus a half. Now, if you are long this portfolio, you have a delta of zero. Now, delta of zero means you don't earn money from delta, correct? What's happening here is, and I have mentioned this, okay. So you're long the call at 50 delta, you're long the put at 50 delta. So your net delta is zero. And your net delta is zero only because your payoff is like this and you are right at this point. Okay? So when the price changes, either it goes this way or when it goes that way. So first of all, you're going to make money from your gamma, but it doesn't stop there. You are also going to make money from the call delta. You're going to make money because the price is rising. Okay, it looks like you are delta neutral, but actually it's only at that one particular point. You're going to make extra money from that, which is why you will end up earning more than 26.25. So the interpretation can be, number one, you make money from the gamma revenue, and number two, you make money from the sigma going up. But number three, there can be a second order effect on gamma because of the Vega changes. Looking at the question, it is uncertain to me whether point number three, whether the examiner actually has that in mind, or even if they do, how they actually would play out. And because of that ambiguity, I would say that 1 and 2 would dominate. That being the case, because gamma is changing, as you pointed out rightly, and gamma is increasing, so definitely you will earn more than 26.25. Okay? 26.25 will be a minimum. Okay, now let's try to if you are long the put, the delta is negative. Is that your question? Sorry, can you say again? Mm-hmm. No, the put you make money from the put. In this case, the put price will actually go up because the share price is dropping and you are long the put. You're going to lose money from the call, but the put price, you pick up money from the increase of the put price. Is that okay? It's not okay. What's not okay? When you are long put, you are correct. Yeah. No, when you are long put, when you are long the put and the share price drops, you actually make money from the put option. No, I'm trying to figure out what is bothering you. I agree with what you said. You know what? Actually, let's keep it easy, nice and simple. Because of that ambiguity, so the only thing that you can tell certainly is that there is gamma revenue, number one, okay, and there is money to be made from the increase in vol, so you know that too. And number three, your gamma should also go up as you get nearer the money. Okay, now I know we discussed this. Oh, well, you know, your vol goes up, so your gamma should go down. I agree with that, but it's not clear how that impacts. And they did say that you don't keep gamma constant. So I think this question, the third consideration should be that gamma itself is on the rise, okay? Which is what we've been saying all along with all those graphs, particularly this one, okay? I think that is the point of this question. So I saw the answer and I didn't discuss the intention with Govert extensively, okay? Is that okay? No? Yes? Maybe? The last one, okay? All right, look, guys, don't worry about the delta, okay? Don't worry about the secondary effect. So you have gamma revenue, you have revenue from Vega, and gamma is going to increase, so your gamma revenue will increase as the price changes. I think all of those three things I just said are all valid, all of them, okay? That would be one way to look at it. And number 6, you know, I want to space them out and I want to be able to write on them. So I'm going to wipe out question 7 from here. I'm going to wipe out question 6 from here. Okay, so for question 6, with the share price at 50, my option position, which is not yet delta neutral, it has the following Greeks. Today is the start of October, so I am long gamma, I am short Vega, I am short delta, and I have not hedged my short delta. So what might be my position? That is the question here, okay? If I'm long gamma, I am short Vega, I'm short delta. What is possibly my position? Am I long a October call, which is slightly out of the money, and long a November put, which is slightly in the money? Now, you can look at it like this. So A, B, C, and D. They are the four choices. So I'm going to look at the gamma and Vega and delta positions for all of them. Now, if I'm long and long, I don't even have to know what I'm long at. Okay, so here I know I must be long. So for option A, I would be long gamma, I would be long Vega. So question A cannot be, sorry, answer A cannot be right because it says I'm short Vega. So I'm long gamma and I'm short Vega, I'm short delta. Okay, so A is nonsense. And if I'm long a call and I'm long a put, the put is slightly in the money, the call is out of the money. So a call delta may be something like 48, whereas the put delta may be something like, let's say, 51. So on a net basis, I would be slightly short delta. Okay, so at least for delta, choice number A is correct, but for the other, they're not. You know, for Vega, you are for choice A, you are actually long Vega. Now choice B, so you are long 51 October call, and you are short a put. Now because you are long a short-term option, and you are short a long-term option, so you would be long Vega, long gamma. It is true, okay, and the longer-term option would have more Vega than the shorter-term option, so you will be short Vega. So far this looks okay. All right. Now the thing is, if you are long a call, you are long delta. You are short a put, you are also long delta. So end up you are long delta. So this cannot be true because you are short delta. So B cannot be correct. Now get on to C. So C, you are short a put, which is shorter term, and you are long a put, which is longer term, so you will be short gamma. And because you are long an option which is longer term, you will be long Vega. And as for the delta, now here C is interesting because you got two options, they are the same side. Okay, so you are short a put, slightly out of the money, shorter term. So let's say the delta of this, so you are short the put. So sometimes when you draw these diagrams, it helps you. So you are short a put, and the at 49, and the share price is now here. So you're comparing the deltas of these two things. And this is the one you are short. So the delta may be like maybe 48 or something, okay? Whereas the delta of the one you are long maybe 49. So this one you are long, this put here, so you would be short delta, whereas the short put you would be long delta. So on a net basis you will be short delta. Okay. So C cannot be correct because you are short with C, the gamma is short, but you are long gamma. Okay. Now for D, if you are in the exam and you are rock solid, completely certain that A, B, C are wrong, probably you would just pick D and then go on to the next question. But since we are not in the exam, I'm going to look at this. Okay. So for D, so you are long a short-term call, and you are short a long-term call. So gamma has to be positive because the short-term option has more gamma. Okay. However, the short-term option has less vega. So this one has less vega. This has more vega. Okay, and you are short that option, so you would be short vega. And as for delta, now it's the other way around. So you are dealing with options at strike 51. I think I can try and draw it better. So you are here. This one is the one where you are long. Compare with this one. So from here to here, it's actually steepening. So if you are long this option at the bottom, your delta may be something like, let's say, plus, I don't know, 47. Okay, whereas the delta here may be 48, but you are short this one, so you'll be minus. So end up you are short delta. Okay, so the last choice is the only one that matches. Long gamma, short vega, short delta. All right. All right. Now, oops, did I skip a quick? No. Okay. So question 7. We discussed skews which result in higher volatility for out of the money puts compared to out of the money calls. We have the following position with share price at par. So you're long a put at 95. So you're long an out of the money put, and you are short an out of the money call. The position that you have, if the stock price right now is 100, is you have this. You are long a put at 95. You are short a call at 105. Now, normally, when you are 5% or $5 out of the money either way, we did say, and we have been telling you all term that things are symmetric. So you may be approximately gamma flat. In fact, it says gamma flat on all of them. Okay. The thing is, what happens to your theta? Now, as you know, theta is a half times gamma times sigma s whole square. So this is like the ex ante gamma revenue. So now you need to try and figure out for your call theta, it's going to be a half times gamma of your call times the call sigma times the stock price. Whereas for your put theta, it will be a half times gamma of the put times sigma of the put. So the only thing that you need to compare are your, okay, so you're long this one and you are short this one, okay? So the only thing you need to compare then, assuming that the gammas for the call and the put are equal, assuming they are, how does the call volatility compare with the put volatility? What is the relationship? And we've already told you that this one is typically bigger than the put vol is typically bigger than call vol, which goes back to a diagram I was drawing to you earlier about the skew. Okay. In option markets, I guess when we look at volatility, we look at three things. Number one, we look at the money volatility for calls and puts. They should be roughly equal. The second thing we look at is we look at out of the money call vol, and we look at out of the money put vols. Okay, in the money volatilities are not really very interesting. Why is that? Because we look at out of the money. Well, what does out of the money mean? Okay, so for out of the money puts, this is time. It means the price is here. You want to know for put options, what is the chance of it suddenly does something very, very dramatic, okay? And normally, so this is out of the money put vol, and on the other side is out of the money call vol. Okay, so this is, please remember when you see the option skews, this is what we are referring to, and you can see that also in Bloomberg. Okay, now what we are telling you is that normally out of the money put vols will be higher than out of the money call vols, which means that your put theta would be higher than your call theta. Okay, and because you are long the puts. Another way to say this is your put options are losing money faster than your call options. And another way to say that is you are actually paying time decay. Okay, so the correct answer is the first one. You pay theta. Okay. Now let me tackle this one. Question number 8. Difficult one. It's not actually difficult. I don't think that's the most difficult question. I find the difficult ones are something like this, when I have to figure out every single box and how it works. Now, this one, we have the following position. So share price 95. You are long a put, which is right at the money, and you are short a call, which is out of the money. I now raise volatility in all strikes. What happens to my Vega? That's the question. Okay. Now, I can point out a number of things. So first of all, a reminder of what Vega is before we go any further. Okay. Now, let me reprise this. I now have a simple option, which is at the money, and volatility is 30. And you can see that Vega is 0.114. What does this mean? It simply means that if I change my volatility from 30 to, let's say, 31, and I hit calculate, now the call price, look at the call price, is 343. It's now changed to 354. So it's changed by the amount of the Vega. Okay. I'll go back to volatility 30. And then the price goes back to 343. But one interesting thing, okay, all right, I'll tell you two things. Number one, the Vega of this option is 0.114. The Vega of an option is always highest when it's at the money, because you are talking about the optionality of this part, which of course is at a maximum when it's at the money. So the Vega of an option somewhere here is very, very small, because there's not much optionality to speak of. Okay, so number one, Vega is maximum when an option is at the money. Now that applies whether it's call or put. Okay, that's the first thing. The second point is the interesting one. Okay, at the money Vega, although it is maximum, okay, does not really change. Now, what do I mean it does not really change? Look at this. The Vega here is 0.114. If I change my volatility from 30 to, let's say, 32, everything will change, but Vega will not change. Can you see that? If I change it to 28, Vega doesn't change. Even when I change it to 20, Vega might change a little bit, but not by much, maybe not at all. Okay, it doesn't change. Now, it's not because there's something wrong with the system, okay? It's because of what I just told you. So Vega is at a maximum when an option is at the money, but it just stays there and it doesn't move around. Now, you compare that with something different. Now I'm going to price an out of the money option, because that is the question after all. So I'm long and at the money option, and I'm short and out of the money option. So now I'm going to try and price an out of the money put. A call, sorry. Out of the money call. And I start with a vol of 20. Now, Vega is very small. You can see that, 0.02. All right. But now if I change the vol, it will move around. Okay. So from 0.02 to 0.027, you might think, well, it's not much. That's not the point. It is changing. Okay. And previously, when the option was at the money, even when I was moving up and down by 10 vols, nothing happened to the Vega. But here I just moved, from 20 to 22. Already it's changing. Now 22 to 24, it will change again. Can you see that? Okay, so the third point I can make is that out of the money Vega is small. We know that. But point number 4, out of the money Vega does change, even if it's just a little bit. And the relevant Greek, I think, is called Vana. I don't even know if that's a Greek alphabet, okay? Which is the change of your Vega with respect to the change of volatility. Okay, that's just for your interest. The discussion of this question is revolving around another Greek called Vana, okay, which is even less well known than Rho. Now we go back to the question, all right? So you are long and at the money put. Well, I don't even care if it's a put or call. You're long and at the money option, okay? So you have a Vega, let's say is 0.6, and you are short. So this is before. I'm going to show you the after. Okay, so you are short and out of the money option. So the Vega is very, very small. It's tiny. So maybe it's just 0.05 minus. So on a net basis, you will be long Vega 0.55, let's say. This is the total. Now what happens after? First of all, this doesn't change. I already told you, okay? But the other one, it will change to, let's say, minus. How about that? Okay? It doesn't matter. Just make up some imaginary numbers, okay? So you are going to be, your total will be like this. So which one is the right answer? Your Vega is smaller. Okay? Very good questions. Some of you need to come up to me at the end to get some participation points. The 2 of you especially. Is it Yuxin? Sorry, I've forgotten your name. You can come up at the end as well because you asked some questions. In the money, thank you, Li Jing. Actually, I should say very, very out of the money and very, very in the money options. Okay? Which is why it's good when you ask me questions, because sometimes there are things I forgot to mention. Yeah, it's like this. So in the money Vegas are small they do change? Very good question, okay? And to show you, well, actually, if you look at the put here, it's in the money, but let's stick to the call. So now it's 110. I'll change this back to 20. So 110, hit calculate. Vega is very small, but if I change the vol now, the Vega is 0.03, it will change. It's not changing a lot, but it is changing, that's the point, okay? 24, it's doing something. Whereas if it was at the money, doesn't change much. 114, even if I pump it up all the way to 35 or 40, I think it doesn't change. This is now at the money. You see? Yeah? So if you can remember these 4 points I made just now, I think you will be okay. All right, now let me quickly just show you what other goodies are in this deck of slides. Just very quickly, a quick review. Now this is a checklist. This is not the entire list, okay? I never put down every single thing you need to know. I can't, okay? But this should be a good checklist of things that you should know about. I put together some slides that I consider to be crucial. Why is that not working? The connection between delta and gamma and theta, the averaging delta, so to speak. I keep doing it like geometry, but there is actually a very sound theoretical basis behind all of that, okay? Which you would find if you look deeper into, let's say, how chapter 13 and your change in portfolio value when you have an option which is delta hedge, how it changes over time. You compare that. So this is essentially the theta, and this is the half gamma sigma S O squared. Okay, so there is a foundation to it. Notes on leverage ETFs. I have written something here. We didn't touch on this too much in tutorials, but if you don't understand something, let me know. Okay, it's mostly to do with what I call beta slippage. When an ETF is leveraged and you have to re-hedge from one day to the next, the P&Ls, they do not line up with just simply doubling or multiplying it by 3 times and so on. Okay, and there's a reason for that. This is really very interesting. It is a reason why you really should not go into leveraged ETFs except for one simple reason, I think, which is if you are looking for a short-term gain, okay, short-term profit, maybe just a couple of days. You invest in leveraged ETF long-term, you can get in trouble. Okay. What else? This table we already discussed earlier in the term. These diagrams are important. Now, I have tried to make it systematic on how when interest rate changes, or when there's time decay, or when volatility goes up, how does it impact in the money call delta, at the money call delta, out of the money call delta, and then the gamma and the theta. Okay, this is not telling you anything that you don't know. Okay, it's just putting everything more systematically. My strongest advice is please don't memorize. Please don't do that. Okay, try and understand why these words are in these boxes. Okay, then you can reproduce that in the exam. Okay, this is for the put options. Okay, this is just the forward vol bootstrapping, so you should know that by now. There is a spreadsheet which does that quite nicely. Now these are some simple rules of thumb. So again, these slides do not tell you anything new. It's summarizing what we've been discussing. When you are long delta, long gamma, long vega, what does it mean? I have some rules here. When it's in the money, how does the delta of a short-term option compare to a longer-term option? Now, I've been drawing these funny-looking payoffs all term. If you are not satisfied with just drawing lines all over the place, there is a theoretical argument to all of these things, okay? And the clues can be found actually by looking at the formulas and figuring out how delta changes when time changes, okay? So for gamma, there are some observations and some rules. Now dispersion trading, I should mention that this non-relation thing is something that Governed and his company came up with, so you won't find that in any textbook. Okay, this is just how they trade. This, of course, is related to your assignment. Okay, now I have other notes on early exercise. You can read these when you get back. And I might try to produce some more videos for that purpose. Okay. Now on rho, well, not just rho, but all the other Greeks, including rho. So here are the formulas for those who like formulas. I don't think you need to remember these for the exam. I don't think so. I mean, it's not going to do you any harm. Okay. And I have written some notes on rho itself. Time decay should be an easy one. Time decay is not linear. It becomes faster near the end, and you can see why there. Okay. So what have we done today? Apart from spending half an hour fumbling and changing classrooms and fiddling with the PCs, we went through the practice questions, and I answer most of your questions. And these concepts that I just showed you, you can go home and have a look yourself. Okay. Now, I really think I have kept you long enough, and wow, 3 hours and 45 minutes. Okay, and my apologies for the slight hiccups at the beginning. If there's anything you don't understand, please feel free to let me know. Otherwise, I will I'm going to produce videos of this morning, and I will put it online sometime today. All right? Well, thank you, everyone. I managed to last for 3 hours. Thank you. Oh, thank you. I'm really touched. So, good luck, and I'll see you on Friday. Okay.